Hey guys, it's a pleasure to be back with a new video. Welcome to Exam Focus. Today we will talk about the what is money market instruments and its types. Please take your notes side by side. So let's head to the topic. The money market can be defined as a market for short-term money and financial assets that are near substitutes for money. The term short-term means generally a period up to 1 year, and near substitutes to money is used to denote any financial asset which can be quickly converted into money with minimum transaction cost. Some of the important money market instruments are briefly discussed below. First is call notice money market. Call notice money is the money borrowed or lent on demand for a very short period. When money is borrowed or lent for a day, it is known as call overnight money. Intervening holidays and/or Sunday are excluded for this purpose. Thus, money borrowed on a day and repaid on the next working day, irrespective of the number of intervening holidays, is call money. When money is borrowed or lent for more than a day and up to 14 days, it is notice money. No collateral security is required to cover these transactions. Second is interbank term money. Interbank market for deposits of maturity beyond 14 days is referred to as the term money market. The entry restrictions are the same as those for call notice money, except that, as per existing regulations, the specified entities are not allowed to lend beyond 14 days. Third, treasury bills. Treasury bills are short-term, up to 1 year, borrowing instruments of the Union government. Treasury bills are the most popular instrument used by the government to raise funds. They are direct obligations of the government and are almost risk-free. It is an IOU of the government. It is a promise by the government to pay a stated sum after expiry of the stated period from the date of issue 4091/182/364 days, i.e. less than 1 year. Third is treasury bills. Treasury bills, T-bills. What are they? Short-term government borrowing instruments up to 1 year, issued by the Union government. Key features: maturity periods 14 days, 91 days, 182 days, 364 days. Risk-free, guaranteed by the government. Sold at a discount and repaid at full value. Purpose: used by the government to raise funds for short-term needs. Why important? Safe investment option with no default risk. Fourth is certificate of deposits. A certificate of deposit, CD, is a financial instrument issued by banks or financial institutions to raise short-term funds. What it is? A negotiable time deposit for a fixed period, 1 to 12 months. Issued in either digital form or as a promissory note. Who can issue CDS? Scheduled commercial banks, excluding regional rural banks and local area banks. Financial institutions approved by the Reserve Bank of India, RBI. Key features: denominations $100,000 to $1 million or equivalent in INR. Very low risk, as they are issued by reputable banks and institutions. Fully governed by RBI guidelines. Rules for issuing CDS. Banks can issue CDS based on their requirements. Financial institutions must ensure their total short-term borrowing, including CDS, doesn't exceed 100% of their net own funds, as per the latest audited balance sheet. CDS are a safe and secure investment option for short-term funds. Fifth is commercial paper, CP, an unsecured promissory note issued by companies to raise short-term funds. Maturity: 7 days to 3 months. Key features: issued at a discount and repaid at face value. Only well-established companies with strong credit ratings can issue it. Freely negotiable and can be transferred easily. Eligibility to issue CP. Net worth: at least 4 crore rupees as per the latest audited balance sheet. Working capital limit: minimum 4 crore rupees from banks. Borrowable account: classified as a standard asset by banks. Minimum credit rating: P2 by CRISIL or equivalent. Purpose: used for short-term financing needs by corporations and finance companies. Sixth is repurchase agreement. A repurchase agreement, or repo, is a financial deal where one party sells securities and agrees to buy them back later at a higher price. Here's how it works in simple terms. Two parties involved. The seller acts like a borrower, using the securities as a guarantee collateral for borrowing money. The buyer acts like a lender, providing cash in exchange for the securities. How it works: the seller gives the securities to the buyer and gets cash in return, like a loan. The seller agrees to buy back the same securities later at a higher price. The price difference is the interest earned by the buyer, called the repo rate. Key features: combines a spot sale, immediate sale, and a forward contract future agreement. The agreement ensures the buyer gets their cash back with interest and the seller gets their securities back. It's a short-term, secured loan. 7. Banker's acceptance, BA. What is it? A short-term debt instrument issued by a firm, guaranteed by a commercial bank. Commonly used in international trade for commercial transactions. Key features: similar to treasury bills, traded at a discount from face value. Maturity typically ranges from 30 to 180 days. Can be sold in the secondary market before maturity. Why popular? Safe investment, guaranteed by both the bank and the borrower. Widely used for financing and settling trade transactions. Bankers' acceptances are reliable, short-term instruments used in global trade and money markets. In conclusion, types of money market are saving accounts, fixed deposit RD, provident fund, pension funds, mutual fund, call notice money, interbank term money, treasury bills, certificate of deposits, commercial paper, banker's acceptance or bills of exchange or letter of credit repurchase agreement, euro dollar, euro currency, and capital market types are equity shares, shares with differential voting rights, preference shares, debentures, equity shares with detachable warrants, sweat equity shares, tracking stocks, secured premium notes, SPN, deep discount bonds, fully convertible debentures with interest, Equipref, disaster bonds, mortgage-backed securities, MBS, GDR and ADR, foreign currency convertible bonds, FCCBs, derivatives, futures, options, swaps and P-notes, hedge fund, funds of funds, ETF, gold ETF. That's all for today. I hope you like it. Please comment your feedback and any topics you want me to discuss. If you have still not subscribed to my channel, subscribe now and hit the bell icon to never miss a video. See ya.